This is the Sensei podcast, where we help you make sense of investments and financial markets, where we help you make sensible financial choices. I am your host, Ndwati Karanja. Are bananas better than oranges? I think the first way you would answer that question is by thinking about your personal preference. But if you would like to be objective, you will think about the situation that you are in. For example, if you're going for a hike, banana will be better because your body would need the extra potassium. However, if you're recovering from a cold or the flu, oranges will be better because you need the vitamin C to boost your immunity. Where we put our money also depends on what we need or the situation we are in. Therefore, when you're talking about different places to invest your money, it really depends on your current situation. And one area of investing is money market funds. I think you've probably heard about them, and they're quite common, and because of certain characteristics that they have, we tend to gravitate towards money market funds. However, they do have their uses, their specific needs and circumstances when we are to invest in money market funds. In this episode, I would like to help us know when to invest in money market funds, and the way we do this is by understanding them. We'll talk about what they are, we'll talk about what to expect from a money market fund, and finally we'll talk about the uses for a money market fund. So let's start with talking about what money market funds are. Money market funds give you access to the money market. The money market is made up of financial instruments or financial investments that have a maturity of less than 1 year. An example of a money market financial instrument is a treasury bill. To understand what a treasury bill is, think of it as the government's mshwari. When you get an mshwari loan, it's usually just for 30 days. And that is essentially what it is. It is the government borrowing for short periods of time. And on top of these treasury bills, there are also other instruments, for example, by companies that are borrowing for short periods of time. And the way they use that money is to pay bills such as salaries whenever they are short on cash, or to make sure that they have a smooth cash flow. That is why governments and companies usually borrow money from the money market. Therefore, underlying a money market fund, we have all of these short-term financial instruments. What a money market fund does is that it gives you access to these instruments because they have unique characteristics. For example, treasury bills, you need a minimum of 100,000 to invest in one. And when you're investing in a short-term loan that is offered by a company, which is called a commercial paper, you need at least 1 million shillings. And also, these instruments are not traded in, let's say, the Nairobi Securities Exchange. And therefore, it is not easy for you to buy and sell them whenever you want to turn them into cash. A money market fund helps you invest in these instruments in a way that, first of all, it is liquid. You can easily get your money back whenever you want it, and also you don't need a huge amount of money to get started. Money market funds pool investments from many individual investors, and then they use that money to invest in these money market financial instruments, which include government treasury bills and commercial papers from organizations. Because of the type of instruments that are included in a money market fund, this fund is going to have certain characteristics. There are going to be certain expectations regarding the risk involved and also the amount of return that you can hope to get from a money market fund investment. So what should you expect from a money market fund? Money market funds offer you low returns because they have low risks. Let us first of all talk about the risk. They have a low risk because they're investing in instruments that mature in less than 1 year. For example, think about you lending money to someone. If they are borrowing it for just 1 day, they tell you they're going to return it tomorrow, and there is very low risk of them failing to return it because it is such a short period of time. However, if you lend it to them for the next let's say the next 5 years, it becomes more likely for them to not pay you because things can happen during that 5-year period that is going to keep them from paying you. For example, they might lose their job. They might simply forget that you had loaned them money. Because of the short period of time that the investments that money market funds are put in, they are low risk. The only thing that in a money market fund that is can be thought of to be a bit of a high risk are the commercial papers, because you're borrowing from a company. There are times that companies have not been honest, and these money market funds invest in their commercial papers and they end up losing their money. I think there is one that happened during the time that Nakumatt was failing. There was a money market fund that had invested quite a bit of money in the Nakumatt commercial papers, and the money market ended up going under. However, when it is managed properly, they always focus on strong borrowers, and strong borrowers can be trusted to repay the money that they borrow. And because of this low risk, money market funds, you will expect them to have low returns because there are no free lunches when it comes to finances. You cannot take low risks and then expect to have significantly high returns. It's because you are dealing with people that are strong borrowers. If you're very confident that they're going to pay you back your money, the kind of interest that you're going to charge such a person is going to be low. And that is a red flag that would alert you to a money market fund not being managed properly. If it is offering you excessively high returns, for example, a money market fund is benchmarked against a 91-day treasury bill. A 91-day treasury bill pays 7% in interest. So if your money market fund is paying significantly more than 7% in interest, then you realize that the only way that they can be doing that is taking a bit more risks, and therefore it is changing the profile of the money market fund that you are investing in. However, in most cases, they are going to have these characteristics. They're going to be low risk, and because of that low risk, your money is very secure in a money market fund. You're likely not to be getting a lot of returns, and based on those characteristics, you would know what to use a money market fund for. So what are money market funds used for? I will say you never use a money market fund for any kind of long-term goals. Because of the low returns that you're going to be expecting from your money market fund, you would use it for short-term goals. For things that you need to have the money in about a year or just slightly more, for example, when you're saving for a wedding, you're saving for a new car, or even when you're holding on to an emergency fund, these are the type of things that you would invest in a money market. And the reason that you don't use a money market fund for long-term goals is because, let's use the example of your retirement. If you're retiring in 15, 20, or 30 years from now, it is very important for your money to grow significantly over that period of time. Otherwise, if it doesn't experience some good growth over that time, you're not going to be able to meet that target. If by the time you're retiring, you need to have investments that are going to be giving you an income that is equal to what you're earning right now, over that time you're saving, your investments need to grow. And the fact is, a money market fund, because it is safe and it is offering you low returns, cannot give you the kind of growth that you would expect from it. Therefore, you only save in a money market fund for things that you require in about a year or slightly more. Another way that you can use a money market fund is to accumulate a capital base. Because money market funds allow you to start saving with small amounts, let's say 1,000 shillings. I think I've seen one that does 500 shillings. And you would like to eventually graduate to something that maybe we'll explain in a future episode, called an equity unit trust. These ones usually require a bit of more money to start. I think there's some that you require about 50,000, or for example, if you would like to invest in bonds, those ones also require 50,000, and some 100,000. You can use a money market fund to start accumulating your capital. For example, you give yourself a target of 2 years where you save 2,000 shillings every month, and then once you've reached that target of 50,000 shillings, then you start investing in other things. That could be another use for your money market fund. Therefore, those are the two reasons for investing in a money market fund. If you want the money in a short period of time where you value the security of those funds, but you're not expecting to earn a lot of return from them, then it is a good place to put your money. Or if you would like to start accumulating capital, and you would like that capital to not be eroded by inflation, to just grow slightly, to have just slight returns, then a money market fund is going to be perfect for those needs. So if you've been thinking of investing in a money market fund, then there you have it. Remember that money market funds are invested in securities that mature in 1 year or less, and therefore because of that they have low risks and subsequently low returns. If your money market is earning high returns, then it's probably not a money market, so you should not expect it to have that low risk that you will expect from a money market fund. And therefore, because of the low risk and the low returns, money market funds are ideal for short-term goals. Money market funds are going to probably draw you because of the security that they offer, and they're likely to be the first thing that you ever invest in. However, even though that is the beginning of your investment journey, it shouldn't be the end. The same way that a banana is good for hiking and oranges are good for when you want to strengthen your immune system and you have a cold, then money market funds are good for certain situations, but not ideal for others. If you have a short-term goal, definitely go for a money market fund. But if you have a long-term goal, it would be wise to consider other investments that earn higher returns, even though they have higher risks. This has been the Sensei podcast. We release new episodes on Wednesdays and Fridays. Please subscribe and leave a comment on your favorite podcast provider. I am Ndwati Karanja. Until next time.